Right after a great breakout move yesterday in the markets, looking for a good follow through coming after the jobs number today, we didn't get it. In fact, it was a very, very small move. We've seen this kind of trade before. In fact, very recently. So I'm going to show you when was the last time we saw a day like today? What does it mean, especially in context of this intermediate pullback that we're on right now? On how likely we are that we're going to continue, and what kind of move, what can we expect to see maybe as early as even as Monday or Tuesday of next week. So I'm based off of what we saw today. So we're going to break that down in today's video. I'm going to show you kind of what's driving price action. What's the big dominating motivating factor right now? It's really moving price across all these different asset classes. We'll talk about that and why we see that, and then we'll talk about a trade of a stock that's got a really good breakout pattern of its own that we would really like to see the markets do, and we'll talk about how to trade it. So let's go ahead and get started. Today is Friday, October the 8th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. It seems like we're getting very similar end of the week that we got a couple of weeks ago when we rallied up towards the 30-day moving average, obviously lower now than what we were there. Near-term line makes its way into the bullish territory, makes its way into the upper reversal zone, just barely, but does not get above that 90th percentile. So that up, when you get that nice little breakout of a new trend starting, they get the intermediate line into the upper reversal zone itself, the green line, and stay there for however long we trend. So we don't have that pattern yet. In fact, the momentum line actually dropped back down into bearish territory, just like that, after its own little foray into bullish territory for the first time in a few weeks. That to see the red line hadn't been up above 50, except for that one little toe dip there. The red line hadn't been above 50 for quite a while, and since the bullish trend ended. So I mean that's a little unique in terms of this peak compared to that peak. But the difference here is this peak's got a long upper shadow, and again another very small range, about half, less than half of the average, as you can see up here at the top, less than half of the average range today, and you'll see with the volume pretty light and still a full 1% below. In fact, over here we were actually closer. We were only 0.5% below the moving average. We're still 1%. So it's to get small ranges. We talked about this in our technical analysis class. To get small ranges below the moving average, it's not typical. Maybe if there's a gap involved, but there's no gap. Both of these were inside days. We had two inside days back to back that particular period, and then of course today's was a pretty decent inside day. Lower high, higher low, but not very much of a higher low. So obviously the momentum line down, near-term line rolling over, market sentiment line still falling. And the intermediate line still in bearish territory. It's rising, that's why you have the light green shading, but that's what a bearish trend will do, right? A bearish trend will alternate between light pink and green, and sometimes if you have to go out to get a regular intermediate run, you can kind of see, you have quite a few, like a pretty long period of light green shading there, and actually turned into dark green because you had a little bit of a peak. Here's another light green shading in the midst of two dark pinks, light pink, lots of light green shading in here. See, it's a little different than when you're on a bullish run. It's pretty much straight dark green shading. We don't get a whole lot of light pink, just a little tiny bit. So there's an intermediate run there where we had just a day or two of light pink shading, and that was it. But when you are in a bearish run, you get lots of light green shading, lots of it. That's just the nature. The intermediate line doesn't stay below 20 for very long. It will stay in the reversal zone and might get into neutral territory here, but it doesn't really get into bullish territory. Even there, just a little toe dip before we really hit the fan. Christmas 2018. Just remember, again, when you hear about seasonality, just remember that we were really, just like we're really bullish now. Going into September, October, before this little last pullback we've had, we were pretty bullish there too, going into September, October, and then that persisted all the way through to December. So that's kind of where we're at right now here with how bullish we were year to date going into this particular fourth quarter. So now let's take a look at some of the other indexes. The Dow Jones Industrial Average, you see, let's go back to just a 1-year chart. The Dow Jones Industrial Average is in neutral zone, so we are above the moving average there. Again, very small inside day, so not really following through. And again, light green shading in a yellow line can be a bearish pattern, just like light pink shading in the yellow line can be a bullish pattern. So we'll see how that plays out there. NASDAQ 100 is still more than 2.5% below the moving average. Engulfing pattern there. We did start filling in the gap on the NASDAQ 100. The near-term line avoided. We did get up to 87, so we didn't get above 90 there. And we've already rolled back over. The momentum line's already back down to extreme lows, real significant bearish lows. And then the Russell 2000, which had been a little bit more bullish, back down more. In fact, I think it was down the most today on a percentage basis. Its intermediate momentum line or long-term market sentiment line still strongly in neutral territory. I mean, smack dab on 50, both of them. Just right there. I mean, they're 49.3 and 49.8. Can't really get more neutral than that. Momentum line's down, near-term line's up a little, but again, not getting up to like strong breakout type levels. So relatively like it's a bearish. It's a bullish run within a bearish trend. We are in a bearish intermediate trend right now. It's small, right? Just a few weeks, and this is a very typical bullish near-term rally within a bearish intermediate posture. Very, very typical as of right now. Let's go back to the S&P, but look at its weekly chart. So you can see again, the near-term line did come out of bearish territory and momentum line, but they're not getting into bullish territory, and it's already kind of rolling over a little bit. The intermediate line still hasn't crossed below 80, just to kind of give you an idea of how strong the long-term trend is. We're just barely getting out of the upper decile, much less out of the upper reversal zone, which you can see once we got in the upper reversal zone back here in July of 2020. Even though we had a little bit of an intermediate pullback there a month or two later, it's been above 80 this entire time. And you can see that's kind of what it does. Briefly, light pink shading in the yellow line, but those tend to be really bullish patterns when you get those. And we haven't even got that yet. We haven't even got a light pink shading yellow line, which again, when you're looking at market sentiment declines, like we had here, these were both market sentiment declines. That's what you end up with. The intermediate line comes out of bullish territory. In this case, got down to the neutral zone, almost in a bearish territory. You got some dark pink shading there briefly because of that. But in this market sentiment rally, which actually was, I think we got a death cross just briefly on that one. Let me go check here really quick. Yeah, we did get a death cross environment there just briefly in the fourth quarter of 2018. So it ended up being a little bit more. This one was not a death cross. Right? We didn't get below the 50-day long enough to get we didn't get below the 200 long enough for the 50-day to get below the 200. Right? You got to be trading below that. So we did in the fourth quarter of 2018. Obviously, we did here with the COVID low point too. So when you're looking at these long-term trends, when you get the market sentiment declines, you're going to get the light pink shading and yellow line. When you get the death cross environments, you're going to get the dark pink shading and the red lines on the weekly chart. That's what we got these last few times. We got it over here. This was a bi-headed death cross monster there that didn't last very long. Not a bear market. None of these were bear markets. And if you're wondering, well, then if the COVID drop's not a bear market, if that's not a bear market, then what is a bear market? That's a bear market, right? An extended death cross environment. Not one that only lasts a couple of weeks. It has to last an extended period of time where we fail at the 200-day moving average and we get below the 30 weeks. See, we're not even below the 30-week moving average here. We're still 2.5% up above it. So kind of gives you an idea. Another look at the weekly chart here. You can see we're continuing to get bearish candles. Next week's candle, we're going to open up roughly about 43.90. We're trading right there at 43.90. So, next week, we either continue with the bearishness and get a very similar type candle like we've had here, some long lower shadows, or we get a neutral candle and we turn it around from bearish to bullish. So that's very, very important week. This Hakinyashi differential down here, the green line is going to jump up towards zero. We're going to have a very small body to open the week. How we finish the week depends on how we trade, but you have a falling PPO. We still have the red line, which we haven't ever had on the SPX for a long since September. We have it on the NASDAQ 100 as well. We actually have it on the Russell 2000 too. So we had a green line, but last week we got back to red, and we're back to red again. So lots of transitions. We're not really getting a trend one way or the other right now in the Russell 2000. If you take a look at this chart, whoops, not that chart. If you take a look at, where is it? This chart. So remember we said, if you get light green shading, it can only last a day or two. If it lasts more, then, it's one thing to get light green shading in the market forecast, not here, right? So when you're on a bearish trend, an actual bearish intermediate trend, so let's come back over here. So you might go from clear to pink, but you don't go to green. And that was kind of because we did have a little bit of a bullish run there in the middle. But go back to these two, and you notice no green during that bullish intermediate run. No green over here during that bearish intermediate run, excuse me. And here's the death cross environment. Just a little bit of green, just a few days, and we were back down. And the same thing in the fourth quarter. Just a little bit of green, and we were back down to the downside. 3 green arrows gives you the green shading. So we're getting green shading on the Dow Jones Industrial Average. So now if we're going to be bullish, we're going to need to follow through on this. If we're not going to be bullish, then we're going to roll back over and like the Russell did, not get green, get clear again just after one day. So, and then of course the Dow and the S&P are not clear, right? They are, here we go. They're not green. They're still clear, right? So they're not pink or green. So we're still in bearish territory on all of these. And again, the Dow looks like it's very likely to roll over again next week. Take a look at the 2-line version of these charts, and you can see the S&P 500 came really close to closing back down below the 17-day. We did get an engulfing pattern there. We'll see how that plays out. We did start to fill in that gap. We'll see how that, because if we finish filling in that gap on Monday and or Tuesday, we'll be back below that 8-day moving average. And when you get back below the 8-day moving average, it makes a run, right? It extends away. Now it will come back, right? Because you get big down days and you get big up days. But these big down days are when you get below the 8-day moving average. And the 8 days falling and the 8 days below the 17-day, that's when you get those kind of moves. And so we are set up to get that kind of move early next week, whether it's Monday or whether it's Tuesday, early next week. That's the S&P 500. This is the Dow Jones. Again, the Dow Jones got up to the 30. Got that yellow line, right? It doesn't look like extending. Of course, got the long upper shadow again. This is 2 weeks in a row for the Dow. Gapped up, gapped back down, gapped up. We'll see if we gap back down and get back below the 8-day moving average again. Looking at the Qs, which has been the kind of the market leader, it did not get back above the 17-day moving average and is almost back below the 8 itself. Remember, it's got no volume here below the 8. If you expect it will make a run down towards the 200, that will not be bullish for equities, not even for small caps, right? It will be bearish for pretty much everybody. And of course, small caps giving us kind of a dark cloud cover pattern where you gap up a little bit and you fill in most of that range from the previous day. Obviously getting back below the 30-day, so a little bit of a failed breakout, as well as getting right to about to the 8 and 17 and the 50. Of course, the 200's right there too. I mean, everything's right on top of each other, right at that point of control. If the Russell breaks at 200, there's no support holding it, right? At least the Qs has its 200-day moving average to stop it. The Russell 2000 does not. So if anything hampers risk appetite in general, it might be the Qs that lead the downside, that spark the risk aversion. But if risk aversion hits everybody, it's going to hit small caps really hard because there's nothing holding it. It's a tightly wound coil that's waiting to be unwound. And if it's unwound in the downward direction, if I were to include the COVID drop, so 2 years, the next spot it has to go down to is all the way down to the pre-COVID high point. Maybe stopping here at Fibonacci lines at about 180 is where I would guess it would stop. And dropping on the 180 is a 40-point drop from here. That's from here would be nearly a 20% drop. So maybe stopping at 200 because that's a round number, and you got a couple Fibonacci lines on top of each other there. But there's a little bit of volume there, so that might be the first stop on the initial decline. They get you some bearish runs, and then you get some bullish moves to get back up to the 8-day, 17-day before then making its way down, potentially down to the 180 level. Let's take a look at some of these other oscillators. For SPY, you can see we're still in bearish patterns here. As bullish as this was, it brought the negative indicator down, but it's still easily above 25, so we haven't ended the trend. We came up from extremes, but not above 20, so we haven't ended this bearish move. If you look at the diamond, same thing. We did drop below 25, but we're not above 20, so we haven't completely ended that one either. The Qs is not anywhere close to it, and you have a really strong ADX there. And then IWM is still very neutral. They're still both below 25. It still hasn't broken out, and its ADX is about to get back below 10 again. Again, setting up the coil to unwind. That time it didn't unwound, but it didn't include the whole market, and so it stopped. It stopped at expiration, but that cluster will be interesting to see where the next unwinding would stop if it broke out, of course, to the downside. Your SPX is trying to get in the bullish territory, but not quite, right? The RSI is not getting above 50. The CCI just a little bit above 0. Your NASDAQ 100, same thing, not getting above 50, not getting above 0 yet. The Russell 2000, it's stuck in the neutral zone between 40 and 60, between 100 and negative 100. It's not really breaking out one way or the other. Look at the Bollinger Bands for SPY, right at the top of the band, so not getting into the upper half, which is what you would need. Looking at the Qs, we're still in the lower half there and still got that big volume node on top of us. And then looking at IWM, the point of control is still on top of us, and you still have a very tight bandwidth inside of this squeeze. I mean, in fact, if you look at this bandwidth here, let me go all the way back about 10 years. I mean, to kind of give you an idea of where the top of the bandwidth has been. This is that dotted line is where the top of the bandwidth has been over the last 150 days. Is it 150? Bandwidth. Oh, it looks like 63. So last quarter. This is where the bandwidth has been in the last quarter. Now, just to kind of give you an idea, the bandwidth was about this low point over here, is about this low over here, and look at where the breakout occurred in 2018. And again, a breakout when the bandwidth got really tight. You can see what happened to the breakout there and some of these other. Here we had a breakout to the upside when you got a really tight bandwidth. That's about where we're at right now. And we were pretty tight for a long, long time inside those. Lots of red dotted lines, the bands inside the Keltner channels. Well, that's where we're at again, just waiting for a breakout. And a little concerning that where that breakout might occur. Again, coming back to the trend strength indicator here. SPY has had a bearish trend. It's still in intermediate trend strength. So it is dropping, but it's still above 65 and below -2. So we're a little bit into the cloud, but not above that blue line yet. So we still got an intermediate trend strength. The Qs are not there, but it's still got a weak trend. Again, just barely inside the cloud and still below the blue line. IWM is very noisy. It's still not going a direction one way or the other right now. So you kind of get this theme, like, it was a nice, good couple of days, yesterday especially, and we didn't follow through with that. In fact, it was almost kind of worse today because it was such a small range. It was an inside day coming after this jobs number that wasn't very good. So from a technical standpoint, the market is setting up, like I said, to fill in the rest of the gap. We didn't look at that chart, did we? To fill in the rest of this gap here. Right here, going into probably Monday and Tuesday, potentially breaking, and again, if we break below 435, we're looking at getting back below the 8-day moving average, extending away because there's not a lot of volume down there, and the Qs would be obviously forming a new 4-week low point by then. IWM would be breaking out of a really tight range. It doesn't look very tight, but remember, this is only 13 points here. Barely above 5%, whereas SPY is 20, 28, 24 points, so a little bit more than 5% range right now. So that's a relatively tight range too for SPY, kind of both setting up for a little bit of a coiling action over the last 4 weeks. Again, with the breakout anticipated to the downside. If you look at volatility, it's kind of interesting too. It's doing something very similar to last time we had that peak at the moving average, where we dropped from 100% down to 85, 100% down to 85, and now we're setting up for what could be a bounce back up off of this support level, as early as Monday or Tuesday of next week. And again, looking at the volume and the range today, let's go back to the 3 green arrow chart. You can see I told you the range was really small, well below the average, and the volume was really small too. We had 70. How many do we have? 72 million yesterday, 74 million today on SPY. Again, putting those numbers into context here, 74, 73 million, way below the average. And again, it's not a bad thing to get below these averages, volume and trading ranges. The trading range 2.7 is off the charts to the downside. So it's not a bad thing to get those, but it is if you're still below moving averages. It means that you're not getting enough bullish buy the dip like mentality. So we should be still buying the dip. I mean, yes, we bought the dip yesterday and the day before. We should still be buying the dip. We are still in a dip. So that mentality should still be there. We should still be getting big bullish moves to the upside and with relatively big volumes until we get above those moving averages. Then we start to roll over. So to roll over while we're still below the moving average means just like we did over here on that peak when we rolled over right here and rolled over right there. They didn't last very long, and we rallied up. And I expect something similar here. Again, I don't expect our decline. I don't expect the low to be in until we get closer to 2%, because I figure we'll hit the 2% mark again like we did last intermediate pullback by the time this pullback is finally done, by the time it's all said and done. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Share that with our community down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. It tells us 2 things. Number 1, you liked our video today. Number 2, you want us to do another video again Monday. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't even have to watch or click on anything. Also, while you're down there, comment. What did you get out of the video this weekend? What did you like? What did you not like? What comments stood out to you? And whether you agreed with it or not. What questions you have, post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook Live video. If you click on this image right here, or you can come up here and click on Market Outlook Live Trade Review, it takes you to this page. This is where I review at 3:30 Eastern Time live. It's live streamed off this page here, Mondays, Wednesdays, and Fridays. So I review all the trades that I've done in previous Market Outlook videos. We talk about whether we should stay in them or close them, and why and how. Then we also put on today's trade idea that you'll hear at the end of the video. We already put it on today before the market closed. You can catch all the older archives of it right there. You can also see our upcoming classes and trading rooms over here on the right. If you click on view more or come up here and click on trading rooms, it takes you to our calendar. Here's all of our upcoming classes as well as our prior recordings. Coming down over here, if you click on this heart icon, click on that right there. That takes you to this page. Hit that like button. Also, click that thumbs up icon. Takes you to this page, and hit our like button there too. Again, the more you do that, the more our content gets seen by all of our followers because of the engagements it has, right? Because of all the likes and the shares and the comments. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching the video. You just come over here and just click those likes while you're watching us. All right, now let's talk about what's driving the price action. Look at this. This is a 3-month chart. You can see as equities have been peaking and then declining across the board, so have bonds. Bonds and equities have been dropping, or bonds and stocks have been dropping together, moving together in the same direction. That usually means we're in an inflationary environment. Now that usually puts pressure on the dollar, but the dollar's kind of rallied at the same time that commodities have really rallied, which is a pretty decent sign of inflation. Real estate also being bullish, at least initially here, and you can see real estate actually is stronger than long-term bonds and some equity asset classes. So again, sign that inflation really is a big thing right now in the marketplace. If you just look at today alone, here is October the 8th, and you look at today alone here, you can see, international stocks did well, gold did well, commodities did well. That is a bearish dollar pattern, and that's what we had. And down here at the bottom, interestingly enough, real estate dropping down, but so did equities and bonds. Like, again, not too common to see small cap stocks and long-term treasuries moving in the same direction. And this is a pretty significant move. It's not like they were both as kind of like, 0.7%. They were or 0.07%. They were 0.7%. That's a relatively significant move for both of them. Let's take a look at long-term bonds. Again, you can see getting a cluster today. Its intermediate posture has been bearish for a while, but is definitely bearish now, well below that moving average there, as well as setting up for near-term divergence. See higher lows with the lower lows there, higher lows on the indicator. You can probably also see too here on some divergences on the CCI and the RSI. The RSI not so much. The RSI is pretty darn low, especially for a higher low point. CCI is definitely setting up for a divergent low point there. Let's see what the MACD and stochastics look like. You can see not so much. The histogram on the MACD is giving us the divergence, but you can see how we're potentially breaking back down below that 23% retracement level. Let me show you where that comes from again. It's this bearish move that we're retracing back to the upside now, but we kind of hit a peak and we've rolled over. And now it's like, okay, we're either going to break back down now to lower lows, which would be higher yields, or we're going to this is going to be a fake out move because we are in a golden cross environment, mind you. So we're back below the 200-day moving average while we're in a golden cross. So are we going to diverge off of that divergent low point, kind of a fake out move below 23% and rally? Of course, that would more likely be the case if we're going to get a risk off move, again, as early as early next week, Monday and Tuesday. Gold really kind of started off strong, ended down. Let me show you what happened with the Euro US dollar. After really breaking down pretty hard on Wednesday, it seems to be halting its move, right at that 50% retracement level, right over here. Again, it's got a little bit more room to run down to the downside, but 50% is also in a Fibonacci retracement level to kind of keep an eye, or at least not a Fibonacci level, but at least the midpoint of this Fibonacci range and the midpoint of the entire move that we're retracing. So that can be a support level too. You can see its histogram has really started rising. The histogram peaked to the downside. Now it looks like the MACD itself is peaking to the downside. So it looks like the euro might make a little bit of a run to the upside, which normally would be not necessarily a good sign. It'd be a sign of risk appetite, but in this case, considering it would be bullish for gold, which is at a support level and potentially rising. Long-term bonds have also been very bearish, so that might be what sparks a little bit of a risk aversion trade, but in this case with a weaker dollar instead of necessarily a stronger dollar. We might still get some strength in some of these different currencies here. If I were to go just to today alone, relatively risk off day, but if I looked at today here and see how everything performed, everything pretty much outpaced the dollar today, including a lot of these European currencies, the euro, the Australian, the pound even. In fact, the only currencies that didn't do well was the Japanese yen, and that's even more safe haven typically than the dollar is. If I were to go back out to the full week, so go back all the way out to Saturday there, you can see the dollar did well against the euro, a little bit higher against the euro because of that, pretty much that move right there. But the dollar was really strong against the yen, but it was weak against just about everything else, right? It underperformed. So it wasn't necessarily even though the dollar was strong against the euro, and that makes up a big, 60% by itself of the dollar index, the dollar really wasn't that strong this week. It's relatively weak. Again, kind of reflecting this this sense of inflation expectation, especially with these commodity currencies, the Canadian dollar, the Australian dollar, really both leading to the upside, very highly tied to commodity prices. Let's take a look at how these sectors were performing here this week. Here's the main sector grid. You can see some of them got above the moving average, discretionary, but that was pretty much it, right? Everything else getting up to the moving averages, they're all still below it. XLK, XLC are below it. XLI, XLB are below it. XLY is trying to get above it, but not so much. All the safe haven areas are all below it, and real estate especially. So again, very, very broad risk aversion trade outside of two sectors, the energy sector and financial sector, which happen to be right now relatively small sectors compared to especially these behemoths that we have up here from a sector weighting standpoint. Right, again, as we look at our trade idea here, remember I've already put this trade on before the market closed in the Market Outlook Live video. Again, you can get that here. That's available for all of our subscribers, our premium and our plus subscribers. Also, remember too, all of our trading rooms, our both levels of subscription gets access to all of our trading rooms as well. Our Q&A sessions, our class forums, our premium tools and resources are obviously only available for our premium, and you can see the difference for those two when you click on the pricing. When you just click on the word pricing there, it shows you the difference of what you get. There you go. So you get the difference of everything, but pretty much the main things you get with our plus is, access to all of our classes, and our premium gets access to all of our classes plus everything else, right? That's kind of the benefit. Plus, while it's a 3-year subscription, it's much lower price, especially when you get our Black Friday sale that's coming up here. Our Black Friday sale, you get access to all of this for only on an average of $66 a month. So it's about a third of what normally you pay for the monthly subscription. So back to our trade, I wanted to take a look at Baidu. So let's pull up Baidu here. And you can see Baidu had a really nice good couple of days. Today you're breaking up 3.5%, getting a light green shading because we're not quite above 50 yet. But we are out of bearish territory. We had a very strong near-term run here. And you have, we're breaking up above a lot of highs. You have a really good opportunity here to the upside. Of course, not quite breaking out on some of these other indicators, though. You notice we're not in bearish territory on either one of those anymore. We're easily in bullish territory at least, if not necessarily breaking out yet. Same thing here. We're not bearish anymore. We fell below 25 or above, and we got a crossover. So we're, we might not be on a bullish breakout pattern, but we're not bearish anymore. So there's an opportunity for a relatively bullish trade. If you take a look at the 3 green arrows, the 2-line version of this, you can see we do have 3 green arrows, and we actually did get above the 30 and the 50 days. So really good breakout there to the upside. Again, yesterday we broke above 2 averages, which is important, and then today we broke above 2 averages, which again is important too. So really good opportunity to at least start filling in this gap. You notice we have a very significant resistance above us at that level at 192 or so. So it's not like we have a big range here. Now, if we get back above the 200 and we get a golden cross, we can get a really good move going. But as of right now, not a whole lot of opportunity to the upside. We are starting to get some bullish patterns, as I showed you before. And if you look at the weekly chart, the weekly Hakinyashi candle here, you can see that we're not bearish anymore either. We got a bearish transition candle that can set us up for a bullish candle here. You can see the Hakinyashi candle getting smaller and turning back up. The PPO looks like it's trying to turn back up there as well. So what we decided to do, instead of doing like a long call option, which would actually be kind of nice to do, but because you have that resistance there, we decided, okay, well, instead of doing that, we're going to sell a put spread at the 155, 150. So if you take a look at that here, let's go to just our single symbol. You can see that, if I sell that put spread, we have earnings coming up, so keep that in mind. That's why we're getting a little bit better return, $495. We're typically shooting for about 350-ish for the $1,000 of risk. We're getting 495. Again, that's because of the risk. But the nice thing is, like, if it turns around, like for us to get, you see where that break even was, ends up being back below the 8-day moving average right there. So we'd have to come all the way. We have to completely reverse this breakout, start filling in the gap from yesterday, and get back below the 8 and 17 day and get back below this volume. So, and then at that point, we'd be down a few $100 and we'd probably take it at that point and move on to another trade. Otherwise, if it keeps going up and starts to fill, it doesn't even have to fill in a whole lot of the gap. It just has to stay above 155, and 155 is right there. So it had to stay above that level for us to make money. And considering the trend right now, it looks like there's a good chance of that happening. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your weekend, everybody, and we'll see you all on Monday.